How's it going? Another week, another round of payments. This week, we're nearly at the $1,000 monthly mark. Our yield is over 45% with a yield on cost of 42%. The market's been pretty decent overall. If we take into a week view, we can see that we're down 1% side. And today we're up 1%. So, all right. Let's take a look, first of all, on what we got paid, what we're buying, what we bought. So got the week's dividends from RDT to YBTC, YMAX, OARC, and Desley. Took all that money and purchased YMAX, more YMAX. I just wanted to increase the core portfolio, and by increasing the core portfolio allows me a little bit more leeway to build up the satellite positions, because that's how it works, and that's how I play it. You could see YMAX, I made a bigger market buy later on, a day later, of $2,500. That was just me putting in, just a couple paychecks worth of extra money. Yeah, that's all it is. Here we can see Robinhood Gold failed to give me a decline check because it used a card that was from years ago, and yeah, it's declined. And we have, yes, the deposit that I made that was used to make this YMAX market buy. And we have this week's dividends rolling in. So Murni, NVIDIA, YMAX, RDT, and YBDC. Total, it's looking like eyeballing it 150-ish, $160-ish dollars. Very cool. Still hoping for a 250 weekly coming up, but since one of our big core positions is OARC, which only pays once a month, it kind of skews it. So if we look back here, OARC paid the 90, so that's why I got paid dang near 200 plus on this week from the 24th compared to this coming one, the end of the month, 31st, which is closer to mid to high hundreds. Now, the main thing I wanted to focus on to this episode and what was requested recently is my puts, specifically the protective puts that I do on a monthly basis. Technically, I just started it last month, so it's the protective one put that we've done, and I rolled it over, not literally, but this one's about to expire. As of recording this, it will expire today, the SPY 531 put. Thank goodness it never had to be used. That's a good thing, meaning our account was able to survive another month, meaning we got another month of free payments. Let's go. I recently bought the SPY 545 put, expiring in March the 7th. Now I'm going to break down how I do it. I'm going to show you how I do it, how I did it, and I'm going to explain the rationale behind why I did it and the percentages that I'm looking at and the thinking and the mindset behind these puts in general. Let's begin. First of all, these SPY puts, I'm basically looking for a SPY put. If you wanted to break it down to its bare bones, you have $100 and every month you buy a SPY put from before the start of the month, and you buy it to the end of the month, kind of like a car insurance, and you literally buy the one that's closest to, I guess in this case would be $1. The one that I bought, I think I purchased it at 97 cents. So $97 I purchased it at. And the reason why I bought it was for black swan events. Specifically, if the market crashes 30% at worst, I will still be able to be in the market. I will not be margin called. If we take a look here, my margin status or my margin buffer is over 7 grand or a 51% margin buffer. Don't really care about the number itself. We care about the percentage because that's what truly matters. So it's a 51% margin buffer. So the market has to go down over 50% for me to even be margin called. So for the market has to go down by half, since a majority of my core positions is stacked, or it is quite literally attached to the overall stock market. The overall stock market has to drop over 51% for me to even get margin called, for them to even consider making me sell some of my assets. The market has to drop 51%. And in my opinion, if it drops that much, we have bigger problems than my little portfolio. The fun part is, if you buy this put, and I'm going to show you here right now, if you buy this put, look to your right real quick, the 545 put in March 7th, we can just do a quick simulation of returns. All right, let's consider the fact that the simulated returns does not take into account the implied volatility, the substantially increased demand of a 30% drop in the stock market in a short period of time, which is the black swan event that we are protecting ourselves from. We don't care if the market drops 30% within the span of years or even year, because by that point, we will be able to survive because our dividends pays it off slowly, and we're able to cushion the blow, and we can still work towards our main thing, which is to get to house money, meaning our asset paid us so much dividends that we have received our initial income back, but we still have the assets, and thus we are now cash flowing. That is the main goal. It's truly the main goal. It is not a matter of if, it is a matter of when. And the more higher the dividends you get, the higher the risk, but also the shorter the time it takes. Margin also multiplies that because you're using borrowed money, which increases the amount of dividends you get. So all of that plays a cumulative role. Now, let us just go down in simulated returns. My worst case scenario, my doomsday scenario that I am protecting myself from at all times, is a 30% drop in the market. All right. So we're just moving our way down all the way to 30%. 30% drop. You can see the simulated returns are looking kind of crazy already. See? Like, it's, and this doesn't take into account implied volatility, the insane amount of demand for something like this, the record demand that would occur if SPY were to drop 30%. This is only taking into account how much money you would make if the contract were to fulfill at the end of the month and the market were to drop 30%. So we're not going to be exactly 30%. Not exactly 30%. We're going to be pretty darn close. Come on. Okay. It's not exactly 30%, but you get my point. Here we go. 11 grand. Our simulated returns 11 grand. The total amount. This is not taking into account implied volatility. I'm not smart enough to truly understand how much implied volatility affects this number. This number could be doubled. This number could be 1.5x. I sure as hell know it's going to be a lot higher than this number. That's the only thing I could definitely promise with an increased implied volatility of a 30% drop with a put like this at this time. So just this alone means that if the market were to crash 30%, I don't even get margin called, number one, in that scenario, and number two, because I need 50% drop to do that, and number two, I get a majority of my money back. So I'm able to weather the storm. I'm able to weather the storm of a huge market downturn because this put will be giving so much money, will provide so much money, and I can sell it at any point in that 30% drop. Shoot, if it drops like that, I might just keep it at that point because the implied volatility and everything. But I'm hoping I never get into that scenario, just like how we were in, if you look to your left here in the 531 put. I am happy. I'm so stoked that this 531 put is going to expire useless, because that means we didn't have a huge market downturn, a black swan event, and I didn't get margin called, and all these bad things didn't happen. So we want this, we want these options to fail. That is the price to pay for playing high dividend, high volatility, implied volatility stocks. It's just like a little, think of it as the insurance, a true insurance that you just need to play this game. I didn't do this the first go around, and it definitely hurt. And I also over leveraged. There's multiple things I could go over the big mistakes I made back then, and highlight them. But I think that's another video for another week, potentially another month. So yeah, that's how I go about the SPY put, what I look for. So essentially, let's break it down. TLDR, we buy a SPY put. We go here. We view all options. And we buy. It is currently, as of recording, January 31st. So you don't want to buy February 3rd because that's 3 days from now. You want to buy it at least 30 plus days ahead. So I couldn't do it 28. Typically, you could buy it. Typically, you would, like, you were buying it in March. You go to March 31st, right? So you get 30 days. So any number above 30 days, so that way it's a true monthly insurance. The closest one was March 7th. So I bought the March 7th. And you look down here and you find the one that has the asking price that is closest to $1. You're not buying a call, you're buying a put. The one closest to $1. As of recording, the one closest to $1 was $5.45. I just purchased that one, so great. And it even shows you the percentage to break even. That really doesn't matter. Do I look at percentages like to break even and stuff like that? Not really. What you can do if you really wanted to was is find a calculator. Let's say I guess I don't want to show it right now, but there's a calculator you could just do. Do 607 to 545. What is the percentage change between the 607 to 545? If that number is greater is less than 30%, I think you're good to go. And use the simulated returns key. You can use the simulated returns that I previewed a couple minutes ago. You could use that to get a sense of how much you'll get paid. Of course, it's completely calculated and doesn't take into account implied volatility, so it's more of a conservative view in comparison to what it truly is. If you were to drop 30% really quickly in the span of a couple days in a market, in the US market, for total stocks, that black swan event would ramp up the implied volatility to like no other. The VIX would be insane, and the demand for such a thing would it be outrageous for me to say 2x 3x what the simulated returns would say? I don't know. I don't really know, and to be honest, I don't want to know. But if you want to be completely conservative, such as I, just make it close. Just check the simulated returns, go down 30%, and if the number you see is close enough to the total number that you have vested into your account, then I think you're good to go. Some people have suggested that this tactic of buying one put for 1 month should be good for you until you hit a total number of like 100K in your portfolio. Me, I'm a little bit more safer because there's margin involved in my account. So I like to think of it as every 10 to 15,000, I'll buy one put. So when I hit the magical number of 20 to 30K, somewhere in between that, I might increase the amount of SPY puts that I buy per month to 2. So I'll buy 2 of these 45.45s. Of course, that means I'm now paying $200 minimum, which kind of sucks. But again, it's the price you pay for insurance. Just like anything. Your car has insurance. If you're in the US, your healthcare has insurance. Your healthcare insurance, you definitely feel that. If you bought a new TV, your TV got insurance. I'm bringing that up because recently we just did get one. But yes, everything has insurance. But unlike healthcare, at least there's no deductible. If the market goes down 30%, you are getting that money back. Not all of it, but you're getting a lot of it back, especially if it's within A 1 month period, 30% drop. My goodness. Yeah, just thinking about it is actually crazy to me. But you never know. You truly never know. So yeah, those are things. Just wanted to go over that once again. Thanks again for watching. This is another quicker video. Probably not. I hope it's quicker. I'm trying my best to make this a little bit more engaging. But honestly, I ramble a lot, so apologies for that. But if you're still here, I appreciate you. Leave a like. Check my posts. I'll be posting whenever, as soon as I get the dividends for this week. You already saw it, the Murny, the Nvidia. That'd be about $100 to $200, somewhere between that. Couldn't calculate it completely in my head, but yeah, we're doing pretty good. $30 daily, monthly getting $918. If you minus the 100 that I'm paying for the insurance, is more like $818. If you minus, and you've also got to take into account margin, because I'm using margin on this, the 70% margin. How much am I paying on that? It's about 5.75% of the total that I'm using, $10,503. The reason why it's $503 was because of the Robinhood thing, the declined payment. Yeah, they wouldn't use my margin because I I stopped the borrowing limit at exactly 10,500. So I will fix that because I don't like these weird, funky numbers. So as soon as I get my dividends, I will immediately change that margin total back to 10,500 and we'll be good to go. The amount of margin usage I still have is still stuck at 70%. I don't know if I will bring it down anytime soon. Honestly, as long as we ride this wave, we'll be doing good as long as margin maintenance doesn't suddenly jump, especially for my core positions, jump to 50, 75%. I think we're still grand and things are looking up. Things are looking up. Hopefully next week I'll be giving you another update, whether we'll be weathering another storm like we did weeks ago, or whether I'll be a little bit cheery to this week and just be saying, oh, we're down 1%, but we made damn near way more than 1% in this week alone. So yeah, thank you again for watching, and I'll see you next week. Bye bye.